from Excedea. Today I'm in Marbella. Here it's January, and I was thinking I would talk a little bit about venture capital and investments, and specifically from an entrepreneur's point of view. That how does it work? Myself, I've come in contact with venture capital and investments. I pitched to investors. Then I have taught venture capital and how to raise and manage it in business schools. Also written some postdoc papers on it. That's something you can find online. I'll try to find you a link to that. And then also I've been a co-owner of a VC fund, and also right now I'm an investor in about 10 different portfolio ventures. So I get from time to time some questions about how it works and sort of what to do about it. And I thought I would share sort of three things that I think are not so well known about venture capital companies, and in a way you could say that three things that VCs don't want you to know about it. So the first thing is that VCs don't have any money. That since they are investing millions, that can come as a surprise to some of you, but in reality that's true. So the VC is just sort of an empty shell which is directing investments from so-called limited partners who have the money. And usually the limited partners say, okay, I'm going to commit $1 million or 2 or 5, and then they pool it, and then the VC promises to invest it in a certain way. And that has quite a lot of implications, actually, that they are just money managers, like, VCs are just like sort of bank tellers, the bank guy who's sitting there, which is very sort of bound by the rules. So that's something which is very important to understand. And also, I mean, those limited partner money, it doesn't also sit on the VC's account, which also it comes later than when the investments are made. So that's important to understand in many ways. And the second rule is that the VCs actually cannot make any decisions themselves. So they can make very, very few decisions because they have committed themselves to being to investing according to certain really tight criteria into certain sort of types of companies, and also with certain contracts and so on. So actually their hands are very tied when they are going to invest in companies. You'll be surprised if you would look behind the scenes how tight their hands actually are, and you can try, for example, to negotiate some more exotic terms into your agreement with the VC, and that's not going to happen because their hands are tied with some of the promises that they have made again to their limited partners. So that's something which is sort of very important to understand, that it's a very inflexible model of getting or providing finance. And the third thing which also comes out of that the VCs don't have any money, and when I say that, well, of course some, the managing senior partner of a VC fund may have some money of them, him or herself, but in reality, the typical managing partner just on, let's say, managing partnership, they just invest a couple of percent of the actual investment capacity of a VC fund. But the third thing is that sort of these three things that VCs don't want you to know is that they are not interested in the long-term benefit of your company. And that's also something which is important to understand. What do I mean with that? Is that the VC needs to return a certain amount of money back to the limited partners, and that's typically it's so that until a certain hurdle rate, the money actually goes only to the limited partners, not at all to the actual sort of active VC guys, the VC team. And this means that they really need to push you to make a big return. And that again is a problem. If you're an entrepreneur, you think you're doing well, you know, your company has grown to 10, 15, 20 million, you're making a couple of million in profit, you're set for life and so on. What does the VC do? And he has the right to, or possibility to push that with all the strict contracts he has put in. He can push you actually to take more and more risk, and in the worst case, you're actually gonna end up bankrupt, and that's the VC's goal. So this may sound like very problematic. It can be, or it can be for some companies a really good option. But I would still, and we at Excedea would think that to also dig a little bit deeper in terms of financing. There's a lot of wealthy individuals. There's a lot of family offices and so on that can really be beneficial for a lot of companies. So they are much more flexible. It's their own money. They can do whatever they want with it. So in a way, you can think of it as sort of circumventing the VCs, the money managers in between, and going straight to the guys who actually have the money. So in for many companies, this is a much better way of managing the process. If you can do that, that's something to consider. But that's something, and that's all I had sort of on my mind today. So please consider it. Please read more about it. Please check out my postdoc research, as I said, online as well, about the relationship between VCs and entrepreneurs. There's a lot of good stories there as well. So that's it for today.